I lived in Brazil in 1997. I had to listen to that stupid AOL sound to get onto the internet. Most people in Brazil didn't have access to that. Well, now everyone has access to the internet. How did that come? Well, it came once we had mobile and everyone was able to have it on their smartphone. That took time. Same thing is happening with the adoption of crypto and the adoption of Bitcoin. You need the risk takers to get this going. Bitcoin could not have the ability of going to 10 trillion, 20 trillion, 30 trillion without all of the OGs that you mentioned putting their money on the line and taking a bet on something to help it grow. But the problem is you need to have the adoption stage. You actually need to have stable coins. You need to have the government supporting it. You need to actually have the ETFs.
This crypto cycle feels different. Since institutions entered Bitcoin in 2024, debates have raged. Some welcome it, others fear it dilutes the ecosystem. After the halving, the market has been surprisingly muted, with giants like BlackRock and Fidelity quietly shaping liquidity and controlling volatility. Even fans of institutional adoption are now cautious, but Jordi Visser sees this differently. Coming from traditional finance, he knows why institutions accumulate slowly and reduce volatility. This friction, he says, is actually bullish, a sign Bitcoin is maturing before its next exponential growth. The bigger picture goes beyond ETF. Visser points to the collision of AI and blockchain. Once AI boosts productivity and tokenization goes mainstream, today's stagnation will seem minor. What looks like a pause is really a recalibration, setting the stage for a surge driven by structural adoption, not just speculation.
Stop. You don't have time. Don't miss out this 2025 bull run. Educate yourself first ahead of the crowd. We have created the ultimate step-by-step crypto cheat guide that will guide you this bull run. Unlock the secrets of crypto and make smarter investments today. Now by clicking on the link below to get your exclusive copy just under $10.
But again, it is higher.
That's the thing, yeah.
And that's the point, is that it wasn't high enough for people. And the frustration level was every time it looks like it's going to break out, it pulls back. But I mean, to be fair to everyone, I mean, it is up. And when we start this today, it is up 13, 14% year to date, which is as much as the S&P 500, which has been, helped by a massive AI bull market and profit margins expanding. And yet somehow or another, Bitcoin has still, in a disappointing year, held in there, and the year is not over yet. So I just think people, again, I really do think people have become a little bit complacent with the way it moves. And in a perfect world, like I wrote about, you want to see the correlation to risk assets come down. You want to see the volatility come down. You actually want, at a time when people are putting it into portfolios, for it not to be basically the NASDAQ. You want it to have its own kind of ability to move when the NASDAQ doesn't move. And that'll lead to better portfolio inclusion. And I think this year, it's worked out well. And everyone I talk to on the financial advisory side, everyone I talk to on the banks, they're just increasing the adoption side. So I do think people have missed the post.com bubble part of the paper that I wrote. I really do believe, if people look back, the entire space has not done well, except for Bitcoin, since 2021. And I just think people are mistaken how much damage was done from that bubble period and how we're still working out of it. And it's a mature asset now, and stable coins are going to allow entrepreneurs to come back into the space that didn't exist in 2021, 2022. So the advancement of stable coins, the advancement of the government, the advancement that'll come next year in tokenization, just stick with it. Everything will be fine.
I know some true OGs from back in the day, having been here in Switzerland. We have a lot of them because they were flocking here early on. And I mean, some of them are like true libertarians, and that's why they got into Bitcoin. And they are making the argument, Bitcoin was born libertarian, anti-bank movement, really this digital embodiment of Occupy Wall Street for central bank skeptics. And now this spirit is sort of fading away.
This is all a progress of exponential innovation that started with the internet. The crypto manifesto that was written in 1988, before the Bitcoin white paper, was in the same mindset of the internet. So I have viewed the benefit of Bitcoin as being not for educated people. The problem is with everyone that you mentioned, and I challenge you to find an OG. If they're an OG, they had money to put money in that was worth something back then. 99% of them were educated. They understood, they had the money to take the risk. The people that eventually benefit the most from this is the same thing as the internet. I lived in Brazil in 1997. I had to listen to that stupid AOL sound to get onto the internet. Most people in Brazil didn't have access to that. Well, now everyone has access to the internet. How did that come? Well, it came once we had mobile and everyone was able to have it on their smartphone. That took time. Same thing is happening with the adoption of crypto and the adoption of Bitcoin. The majority of people that use it in their daily lives that actually care about it are the people with the least amount of money. So 90% of the holders of it are below the age of the baby boomers. So this is a demographic thing that in the end, educated people benefited a lot from the early stage. And that's what the paper was about. You need the risk takers to get this going. Bitcoin could not have the ability of going to 10 trillion, 20 trillion, 30 trillion without all of the OGs that you mentioned putting their money on the line and taking a bet on something to help it grow. But the problem is you need to have the adoption stage. You actually need to have stable coins. You need to have the government supporting it. You need to actually have the ETFs. If not, the true libertarian get rid of government side, it's just not possible. So in the end, whether it's capitalism or whether it's decentralization, the framework between a libertarian belief and a democratization of the ability of people that have no money to buy a piece of private credit, a piece of an expensive building, a piece of Picasso art, that takes tokenization. The stable coins allow Argentines to move their money outside of the system. Bitcoin was never going to serve that purpose in my mind. You needed to have these other components. So I think this is actually going exactly the way it should. And people should start remembering that it's going to bring out the 7 billion people on the planet that have never participated in capitalism. They're the ones that are going to benefit from the democratization of both crypto and AI. It's very hard for me to sit here and listen to people talk about how this is correlated. It's correlated to one asset. Is it correlated to the Euro stocks? I mean, you live in Switzerland. How do the stock markets done there the last 30 years? This is not a correlation. Everyone picks the one thing. Everyone complains that there's concentration inside the S&P 500 because 7 or 8 names are driving the entire performance. Well, if 7 or 8 names are driving their performance, is Bitcoin correlated to the S&P 493? Of course not. Is it correlated to the Russell 2000? Of course not. And the reason I say of course not, if you invested your money in anything but the Mag 7 and you didn't have that in, everyone would be underperforming. Bonds have done horribly. Commodities have done horribly, except for gold recently. But if you take all commodities, particularly oil, you take anything, it's all underperformed. So Bitcoin has not only outperformed, it has been uncorrelated to all assets outside of the Mag 7. And that's the problem that comes in. And that is where when people get caught in this game of statistics and correlations, they're just not paying attention to what's happened. Argentines and Brazilians and Vietnamese and everyone across the planet has not been in a bull market. It has been 7 stocks.
Jordi Visser flips the narrative on Bitcoin's current market behavior. While many retail investors blame BlackRock, ETFs, and a supposed Wall Street takeover, he argues that this friction is not a sign of decline, it's a sign of maturation. The flat price action, constant chop, and grinding volatility are natural when a trillion-dollar asset class transitions from a retail-driven dream to a globally integrated financial system. Yes, it feels slow and uncomfortable compared to previous post-halving euphoria. But Visser emphasizes that Bitcoin cannot reach its full potential without these institutional players. Ironically, the forces many criticize today are the same ones that will drive Bitcoin higher in the next wave, especially as AI and blockchain begin to merge into a powerful, unified economic engine.
I mean, again, at the end of the day, Bitcoin is being driven by the stock market, if we go back to the correlation. So if you believe that earnings per share in the S&P 500 is going to go higher, now historically, that takes liquidity. So to all the liquidity people out there, I like listening to Michael Howell as well, but to me, it's all gobbledygook. We've been expanding the balance sheet forever and trying to time when the debasing governments of the world are going to let liquidity drop off. This has been a big liquidity year. I had heard at the beginning of the year that this would be a horrible liquidity year from so many people, including Michael Howell. So this just continues. Yes, there's a lot of treasuries expiring in the US. Yes, it's causing a little bit of liquidity problems at this point. But at the same point, we're going to do what we need to do in a midterm election to make sure that the economy is getting stronger. And whether it's a Democrat or Republican in the US, they will continue to print money. Whether it's China, they're continuing to do what they need to do. So I've broken that. I've left that alone. I left the dollar alone. I think what needs to happen for people, and the part that they need to get a little bit more comfortable with, is this thing that I wrote about for 22V, which is that the new QE is artificial intelligence. Artificial intelligence means doing more with less. I believe when money flows into crypto, there's a deleveraging part to it. If it leaves the fiat system and fractional reserve banking system, it's a less levered world. And I believe that is the ultimate point for Bitcoin, is for people to hide their money and take it out of the system. People have been moving money into money markets. They've been moving money into gold. They've been moving money into Bitcoin. To me, those are all deleveraging. Those are all anti-liquidity, because there's not as much leverage that's going through the system. The natural leverage that I used to hear about during the 2010 to 2019 period that people said was a negative was money velocity. We had no money velocity. The money wasn't moving. There wasn't well, that continues to be a problem. Stable coins will bring massive amounts of velocity. So the speed of money will change. And I believe that's the change that's going to impact things, because AI is going to make us be able to do more with less. So I'm a big believer that the new QE going forward is artificial intelligence. You get tremendous amounts of operating leverage. We're seeing profit margins go up in the S&P 500. And as long as S&P 500 continues to have a bid in it, then all of the rest of the globe will have a bid in it, in terms of the stock market, who are also benefiting from AI. And as we've talked about, if stocks are going higher, that's more money to transfer away from the fiat system into Bitcoin as part of the natural move, which will be the 7 billion people on the planet, which are going to continue to put money in. And don't forget the demographic shift and the transfer of wealth that's going to occur. You need the S&P 500 to be stable to up. And I think that's going to continue to be the case because of profit margins and because of artificial intelligence. So if you're cutting your expenses as opposed to revenues, you're getting the operating leverage on top of it. So basically what I said is, if you get the difference between a 5% revenue increase or a 5% cut in expenses, it's much better for your earnings per share to come from the cut in expenses than it is from the revenues. So the problem is, for everyone, if we have no employees working, we have a $120 trillion economy, 60 trillion in compensation. I've managed businesses as the leader of the business since 1998 or 1997. And I can tell you, human beings are the most expensive part of the economy in terms of wages. And so if nobody had a job, which is not going to happen, you have an infinite profit. You have an infinite situation in the economy where productivity is basically not going, because you have no expenses on the bottom side. I believe over the next 25 years, we will continue to see advancements in both a reduction in the need for people to work, a reduction in expenses in general, and that's going to lead to more profit margins that'll continue to go higher. And so QE did nothing except move rates down to zero. But moving rates down to zero did nothing to the economy in any big way. For the stock market, what it led to was financial engineering. So you could borrow money at zero. You could go buy back your stock, which had an earnings yield of about 6% plus dividends of, say, 2 or 3. So it was a 9% comparison to raising money at close to zero. So for companies, they did that, and it helped the bull market go. It helped reduce their shares outstanding by buying them back, and that helped their earnings per share. So we're in a much more levered period if expenses go down, and that's where I think we are. And that contributes, again, in the circular nature to, well, that drives household net worth because the stock market goes higher. So far this year, the S&P is up about 13-14% as we do this. It's a $60 trillion situation. Let's put it at 50. That means we added into net worth just from the stock market around the globe, for the people that own it, about $13-14 trillion of net worth. As that becomes bigger and bigger, and it's already over 200% of the GDP of the US, you're getting that operating leverage showing up both in the form of the earnings per share, but also in the profit margins. And just to end this, remember, the S&P earnings this year right now are up about 12 to 13% year over year. Stock market's up 13% year over year. So the stock market's actually going up only at the multiple that the earnings are growing. And I think you're going to continue to see that. So that's where QE, which helped save the market by the stock market going higher, is going to continue to save it. But this time it's going to come through.
Jordi Visser sees Bitcoin's long-term upside driven by technology adoption, tokenization, and AI, while Raoul highlights near-term liquidity measures like SLR relief and regulatory clarity that could fuel a Q1 rally. Together, these trends set the stage for meaningful institutional inflows. This isn't a call for reckless action but for strategic positioning based on adoption and liquidity tailwind. Investors who align with this thesis could benefit as the market moves into the new year. Will adoption or liquidity drive Bitcoin's next move? How are you planning to position your portfolio? Share your thoughts in the comments. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.